All right. Good afternoon or good evening, everybody. My name is Jack Garrison,
Hi, I'm Tyler Hirth.
and welcome to the first quarter of 2026 town hall meeting. We've been doing these town hall meetings for about the past 3, 4 years now. Doing these on the last Tuesday of the month following quarter end. We'll continue to do them throughout 2026. Just a good time for us to hop on here, give a few updates as it pertains to the economy, the markets, some tax updates, updates to our team. Hopefully you guys find them informative. We've gotten good feedback in the past, so we're going to continue holding them. Um, with that being said, today we're going to basically give an update on the economy, some things that are going on inside the markets, just a quick update on a change that we're making inside of our models, some tax season information, a couple of things to keep out for now that tax season, everybody's favorite time of the year, is here. And then finish off with some updates to our team since we've had some good additions to our teammates, and then we'll open it up for some Q&A at the very end in case anybody wants to come off of mute and ask some questions. So you'll notice that we don't have a chat function available for compliance reasons. We had to take that off, and so if anybody does have a question, you're going to have to take yourself off of mute or raise your hand and we'll unmute you. But we'll get to that point a little bit later on. So I'll let Tyler get started with a little bit of economy and labor market talk.
Yeah. Well, hello everybody. Like I said, my name is Tyler Hirth, and yeah, technically I can remember go back to the COVID times when we had to sit 6 feet apart in 2020. That's when we actually first started doing them. I remember Nathan running and I had a 6 foot pole that we like made sure we didn't get. We were in the conference room and we had to make sure we stayed 6 feet away from each other. And we made sure when we did the town hall, we stayed 6 feet apart. So it just when you said, "Hey, we've been doing these for 3, 4 years," I'm like, time flies. I guess it's been 6 years since COVID. So, all right, back to what you guys came for, not me filibustering here. So, anyways, economy and labor market. As you see, as everybody knows, if you're going to jump on this town hall, you're going to hear AI, and we're starting off right away. So, if you had AI on your bingo card, there you go. It's the first time we're saying it. It is driving multiple year economic expansion. I think that's the biggest reason why we saw huge market gains last year. And you saw that in GDP gains last year also. We saw a 4.1 print on the GDP. And you also see that you're going to see Q1 actually be sort of north of that also. So I'm not trying to speculate of what we think is going to happen, but definitely this is a huge more tailwinds of what AI is doing. And we do see this as a very multi-year economic expansion. Productivity is very much growing. We see it here in our office. You see it in every business that you go to. Everybody is becoming more efficient in what they're doing. Some people are taking these, comparing these levels of economic gains and or productivity within their businesses. We look back to the 1960s and 1990s. It's that type of revolutionary development here, and it is huge. Again, when you have those types of productivity gains, it leads to stronger margins, higher earnings, and the stock market's going up a little bit. And the unemployment actually, if you look at the labor market as a whole, people are not being replaced by AI. I think that was a huge fallacy and a huge fear mongering piece that was out there, and I do not. And it is proven that that is not actually happening. Companies are actually just investing more into the people, and to me, it's like adding a computer or adding a calculator to your work. It's just making you that much more efficient, and you're able to drive that much more output. So if you look at the capex in a lot of the economic news that you have, and the stocks that they're expanding and growing, and these are all positive headwinds. That's why I think you're going to see a couple of people I listen to and read. You might see some GDP prints of north of 4.5, maybe even 5. My opinion, this is not any economic. Yeah, don't hold me to any of this. Small business hiring plans increase. I mean, as you see, unemployment is very low right now, and the labor market is really strong. I can't really think of much else to add to that. I mean, I just hope that this sort of cuts through some of the noise out there. It is not all doom and gloom. It is very positive, and that's why we see. We're trying to tell you what we're reading on numbers basis of it instead of it having that emotional feel to it.
Yeah.
Zach, do you have any addition you want to add to that? Or
All perfect. Yeah, economy's in a good spot right now. Labor market's doing good. So from our perspective, we're still positive on the rest of 2026. If you were to wrap it into a nutshell.
and it's only January.
It's only January. We got
Lock
11
it in.
months. We got 11 months left. Christmas will be here before you know it. Speaking of 2026, I know there's been a lot of talk as far as the Fed and the economy goes on what's going to happen with interest rates. That was a huge talking point in the fourth quarter of 2025 was interest rates. What's the Fed going to do with interest rates? And then at the end of 2025, in the last 3 months, the Federal Reserve lowered interest rates 3 times by 25 basis points each time. So what that means is essentially the prime rate or the basic interest rate came down by 0.75% at the end of 2025. I think there was a lot of people that are expecting those rate cuts to continue on into 2026. And based on where the economy is, where inflation's currently standing, and where the Federal Reserve's kind of put its stake in the ground, is there's a very high probability that this next month the Fed is not going to lower interest rates. And so right now, equity markets are pricing in over a 90% chance that the Fed is going to hold interest rates steady with where they're at. And from our opinion, that's actually probably a good thing. You can make an argument either way for it, but at the end of the day, we don't want to go back to a zero interest rate environment like we saw during COVID when interest rates were essentially zero. As much as that'd be for everybody's mortgage rates who have a new higher mortgage, from an economic standpoint, it actually would not be the best thing in the world for us to go back to a zero interest rate environment. And so right now, the Fed's sort of just playing this limbo game, trying to take into account the labor market, the inflation, since that's still a finicky subject when we came back down from where we came back down from in 2022. So it's a delicate act that the Fed's trying to balance right now. And so from our perspective, we're not necessarily relying on any more significant rate cuts at this very point in time, but we're continuing to do our due diligence and make sure that we're reading the most up-to-date releases from the Fed and our economic partners to make sure that we have the most informed data when we're talking with our clients. Dad, you want to talk about some equities for a little bit?
Yeah, sure. When you look at a lot of the Mag 7, or that's another hot topic, probably another bingo card. Tag term there, Mag 7, the 7 biggest firms in the US. They're very strong, and that is basically all driven by actual business growth. It's not speculative growth. I think that is the biggest thing that you want to take away from this is they are actually making production of that. It's not just if they are going to do that. They already are. It's there. The proof is in the pudding there. And the majority of these companies are sitting on, again, tons and tons of cash. And that's where I think you see Microsoft coming out last week or the week before, that they're going to start building their own power plants to set up their own data centers. And so you're going to see a lot of that cash getting deployed. And to me, that's all huge, great economic gains and headwinds for the U.S. economy and the market as a whole, too. So when you see a lot of these bigger companies that are sitting on so much cash, putting their money to work, that's what you want to see, and it's good. Yeah, I can't really think of this is not another one of those bubbles that we can see right now. It is not that I don't want to. We are not economists. Economists, thank you. And we're not trying to procrastinate out of what we think everything is, but from what we read and hear and try to disseminate this information, we do not see this as a bubble out there today. So this isn't another .com 1999 bubble. AI is real and it's here, and it's you're actually able to use it to see these efficiency gains, and you're actually seeing it in the equity markets, how they are the companies that are coming out to be more innovative and reinvest their money into their companies, not a dividend company, a growth company. They're the ones that are winning right now, and that's where you see growth companies are vastly outperforming the value companies. Small caps, you are seeing some of the other mid to small companies out there. So that's not your Fortune 500, that's your next level, your next 1,000 to 2,000 companies in the US. They are actually able to adapt some of these wins. 2025 was all about the Mag 7 and that carrying the market. You are seeing some of that breadth of the market actually then gaining some of the gains also. So you're seeing the other 1,000, 2,000 companies participating in these AI gains and AI headwinds. So I think that's huge. You are seeing that this is an election year. So get ready for all the fun ads out there that will start inundating us here. But I don't think that that's really going to have much bearing on the actual economy as a whole and or the stock market as a whole. We're always going to see volatility and you're going to see the ups and downs of the market. And again, I think that's why you work with an advisor, and we build the portfolios and your income streams to make sure that no matter what the market condition is, we have that place to pull the cash to deliver the monthly incomes that you need. So if stocks are up, we're selling stocks. If bonds are down or bonds are up, we're selling bonds to replenish that cash bucket. So not just belabor on those points, but it's really why we do what we do.
Yeah.
I can't really think of much else to add on that.
The one
You?
piece I'd like
Yeah.
to add in on that, which I know we've mentioned in previous town halls, but I like to reiterate it because I think it's a really good point, is a lot of people, if you look at mainstream media, a lot of people are comparing what's happening now to the dot-com bubble, right? There's so much innovation and so much investment that was going into the dot-com era, same as there is with artificial intelligence now. What I like to point out, and where I think there's a big differentiating factor, is the fact that companies now that are investing so heavily in artificial intelligence are revenue producing companies. They have positive balance, they have strong balance sheets, they have positive cash flow. These are companies that are actually truly generating profits. Where during the dot-com bubble, a lot of the companies were trading at insane valuations and they had crazy multiples associated with their stock price. And some of them were pre-revenue or they were negative revenue. And so during the dot-com bubble, we essentially saw insane valuations of companies with no revenue or nothing to back it up, where now Meta, Google, Microsoft, Apple, Nvidia, all of these companies that you're hearing at the top of the headlines of the ones that are investing so much in artificial intelligence, they have other areas of their business that are producing insane amounts of profit. And so there's just a very clear distinction between what was happening during the dot-com era and what's happening now with artificial intelligence. And I just want to say it's not an apples to apples comparison between those two timeframes because it's a completely different world. And so I just wanted to throw that piece in there.
No, I love it. I think, yeah, you go back to 1990 or that whole piece, you had people making so much money on laying the fiber to nowhere. And it was never going to be used and it never did get used. And I think that was just one of those fallacies back then where I think it's the total opposite with this, where we can't get enough compute today. And that compute generation is why the data centers are being needed. I know firsthand a couple of people that have companies that have been building on computers that are not being used. And like every computer is needed during this, I don't want to call it like a gold rush right now, or an opportunity for every single GPU that could be out there or CPU could be used right now. And it's just such a benefit. This is not the same dot-com bubble, as you said.
Yeah.
I like it. I think we've did well on that.
Yeah, shifting from the company side of things, wanted to talk a little bit about the consumer and what's going on in that end, because from our mind, we're always kind of looking at two things. One, it's like the big behemoth companies that are fueling a lot of the investment and the GDP growth that we're seeing. But the other side of that equation is the consumers. You guys, us, we're consumers. If you look by and large, the consumer is in a healthy spot currently, even though the news and the headlines tends to make it seem like the economy and the consumer's not in a good spot. From a true standpoint, the by and large, the vast majority of consumers are in a good spot where they're continuing to save money. The household income to debt ratios are at a very modest or very okay level, if you will. Household net worth is continuing to increase, and consumers are still spending money, which is a huge component of GDP continued growth. As long as people continue to spend money, then the economy is going to continue to grow. Again, that's one part of the equation, but it's something that we have to take into account. So even though you might see consumer sentiment surveys are not as good as they used to be, that it's a small sample size that they're running that off of. But if you actually look at the consumer as a whole, all 370, however many million people are in the United States, the consumer by and large is sitting in a relatively good position.
I'd love to add on to that of if you look at the normal consumer, the price of gas has gone down as we all go to the pumps. With the price of oils came down, so you see the energy costs actually coming down. When you see these data centers being built with the new power plants in the future in the next 3, 4, 5 years, I think that should mitigate a lot of that energy cost issues. And then when you look at, I like this one, is that the tax refunds that are going to be going out to the people that need it the most, general America, people that make less than 150,000 and below, the tax deductions that are now coming in 2025, which we're going to touch on in the next down in town hall a little bit later. Yeah, that cash in those pockets of those consumers is real. It's a lot of, actually a big chunk of cash coming to them, coming in April or March and April, and in that subset of the population, they spend. So when you go back to the stimulus package, when the government was handing out all the free money, that money got spent instantly. And so I think you're going to see a little bit of those tailwinds coming into Q1, or end of Q1 into Q2. I'm not saying everybody's going to go out and buy the new flat screens like they did during COVID, but you are going to see a lot more cash in the pocket of the consumers. Yeah. And if you look at the credit card debt, I mean, that one has been overblown so much. Yes, the net worth of America compared to the credit card debt it is today is vastly higher. I mean, that delta or that difference is vastly in a better spot, that ratio, compared to where it was back in the 90s when we saw that high credit card debt. So not even close to compare the two. Yes, that number's higher, but if you index it for inflation, it's way lower. And if you put it towards your net value. So,
yeah, that's a really good point. That
one just drives me nuts because you can make any statistic, tell any story that you really want to. So
no,
go ahead.
That's a very good point. Is because the media will say credit card debt's at an all-time high. So is the country's net worth. So is everybody's income. Everything's at an all-time high. So if people are spending and making more money, it's only a mathematical fact that credit card debt's also going to go up along with net worth. So that's where it's like, if you see something on Twitter or X or Facebook or whatever news feed you decide to listen to, a lot of times you have to take it with a grain of salt, and you have to kind of do your own research, or feel free to ask us. Feel free to ask your advisor how to interpret some of the data that's out there. Just, it can be a little misleading. Wanted to touch on our model updates, change that we're making to our models this quarter. Really not making an enormous changes more this quarter, but we are swapping out one of our large cap growth funds for another fund. So part of our job, and what we spend a lot of our time doing, is making sure that we're constantly monitoring the investments inside of our clients' portfolios to make sure that specific investment is the best one in its class. And if it's not the best one in its class, then we're going to switch it out. I know a question I've gotten before is like, well, why don't you always just have the best one in your class? Well, that's the goal. But these companies, the different funds, they change hands throughout the year, and intra-quarter and intraday even. And so you can't constantly be making changes, because then you have zero stability to the portfolio whatsoever. And so what we do is we sit down once a quarter, we review everything, probably in a gross amount of detail. If anybody wants to see the slideshow and want to nerd out with me, I'm more than happy to go through it with you.
165 pages, I believe.
320 this quarter.
Oh, yeah. That was
so 320 pages of PDF data slides. I'm more than happy to nerd out with anybody on. But point is, we're just going to be making that swap on Thursday of this week. Essentially, nobody should feel that difference. There shouldn't be. It's a 1-for-1 swap, so it's just something that we have to do on the back end. But that's just wanted to just full disclosure, fully let everybody know that that is a swap that we're doing. And it's something that we continue to look out for on a quarterly basis.
There is no cost to the client to make that transaction, so there's no fee. We're just enhancing that position, and then there's no tax implication, so you don't have to worry about that either. So it's a win-win-win all the way around for the client and for the whole portfolio as a whole. But there are some clients that don't even hold this AV Alliance Bernstein large cap position, and so it's not even an issue for a lot of clients. But for some that are in that portion of the model, yes, we are swapping that Alliance Bernstein out for the federated attorneys. So no taxes, no cost to the client at all. Seamless thing. It's just something we do behind the scenes to make sure we have the best portfolio possible.
Yep. Moving on to everybody's favorite topic, taxes. tax season is upon us. Our tax team's already hitting the ground running.
It's already January 27th. Wow.
Just in case anybody forgot, which I don't know how you could, tax filing deadline is April 15th. We get reminded of it every single year, and everybody's going to start seeing the H&R Block, Intuit commercials during the Super Bowl here coming up. So just want to remind everybody, tax season filing deadline is April 15th. But on Monday, so yesterday, the IRS opened their filing system. So now tax returns for the 2025 year can start being filed. Although I will throw in there a little caveat, most people's returns are not ready to be filed yet. Most companies have already gotten their W-2s produced, or a lot of companies already have W-2s produced. But if you have 1099s, K-1s, some other 1099 INTs, those aren't going to be produced yet here for another couple of days or potentially a couple of weeks. And if you have K-1s, it could be a couple of months. I'm sorry. It's something we go through every single year. So as soon as those documents start filing in, if you are using our tax team to get your tax preparation work done, feel free to reach out to either your advisor or somebody on our tax team. We can make sure that we get you that secure portal so that you can upload your documents. Or if you don't want to do it online, you can always bring in a shoebox, dump it off. We can scan it and we can start working on the return for you.
Nice you said. Yeah, I think February 15th was one of the other deadlines that I know LPL, Fidelity, Schwab, a lot of them have put on themselves to make sure that all 1099 INTs, Rs, and normal 1099s are produced for the clients. So give it some time. It's all good. It's great that we are very excited to get everything in, but it does take some time for the custodians of those to produce those accounts or those statements.
Yeah. Doesn't necessarily pertain to the 2025 tax year or the 2025 filing season, but with the passing of the One Big Beautiful Bill Act and back in fall of 2025, we did July 4th. Yeah.
Go ahead.
Yeah.
Sorry.
July 4th of 2025. The current tax brackets are going to be continued on for the foreseeable future. So what that means is the brackets are staying as they are. They're not reverting back to what they were in 2017, which we think is a good thing. It means everybody's, for the most part, in a lower tax bracket, which is good. And then the width of those brackets are staying pretty much the same. So you'll see a slight inflation adjustment to the size of those brackets, like you do pretty much every year. But just with the passing of that One Big Beautiful Bill Act, tax brackets are staying pretty much right where they were, again, adjusted for inflation.
Yeah. I guess means I'm up with standard deduction. They actually did come up with a little bit more of an enhancement, $32,000 for 2025. So we need to have a lot of deductions in order to actually itemize. In order for you to take standard deduction, that's for married filing jointly, and $16,000 for single on that aspect. Really not much else. My big thing on this one is to try to bunch your deductions or your stuff that you would maybe just strategize. Maybe 1 year you do take standard deduction, let's say in 2025 standard deduction, and then in 2026 you're going to itemize. So one way of doing that would be is to pull some of the income or your deductions of paying like your property taxes and some other deductions, maybe do a donor advised fund. In 1 year, in that year, you're going to itemize, and then the other year, you're going to take standard. So you want to try to flip flop back and forth. It's a great tax planning strategy that we like to implement here at, and also, that's why you have your advisor here to help you implement some of these tax strategies. I guess on the standard deduction piece, I'll get into the enhanced senior deduction later on in the show.
Yeah. And speaking of deductions, one of the things that we get tons of questions about is charitable contributions. There are some rules around charitable contributions and what you can and can't take. I think the biggest thing that we wanted to touch on was that charitable contributions can be deductible if you do it the right way. There are certain limits, whether you're giving stock, whether you're giving cash, or whether you're giving stuff to Goodwill. There's different rules for each of those. I think what a lot of people, the biggest one that people tend to give is cash, whether you're, giving the offering at church or if you're just giving a cash donation to something. There is a 60% adjusted gross income limit for being able to take a deduction for a charitable contribution. What the heck does that mean? That essentially means if you have $100,000 of income and you give more than 60% of that, so $60,000, anything over 60,000 that you give in cash isn't going to be able to be itemized as a deduction. So you go up to that 60% limit. Again, that's a large number for anybody to give, but we have clients that do it. So always want to make sure that we throw that out there. Some additional charitable giving stuff that we always want to take advantage of. Qualified charitable distributions are a phenomenal way for you to be able to give to charities without necessarily incurring a tax burden for doing so. Now, full disclosure, you can only do this if you are over the age of 70 and a half. So it's one of those things where there's a certain age limit. But in essence, if you give a gift to a church or a charity or any 501c3 organization, that's IRS code for essentially nonprofit. If you give a donation to a 501c3 organization directly from your IRA, that is not counted as income on your personal tax return. Now, you, again, like I said, you can only do that after you turn age 70 and a half, but it's one of those things where if you're giving to charity and you are over the age of 70 and a half, and you're currently doing that out of your checking account, there might be an opportunity for you to give that directly from your IRA, and it's not necessarily going to hit your tax return on the personal level.
Yeah, so you're actually getting a deduction then for giving that money to the charity by not paying income tax on the IRA distribution to create that cash you need.
Yeah.
So it's a huge win for clients when actually doing this right. Again, ask your advisor. Definitely are here to help you. We've got easy ways to implement that strategy by getting you a checkbook and or getting you ways of, all right, if you're going to do these same couple of ones, you can just call in and we can put it in an ACH directly to them and it's all good to go. But it cannot come directly out of your checking account. Sorry for stealing your thunder, Jack.
All good.
I guess I'd add, if you're okay with it, I'd like to add one piece on that charity B piece. If you're talking about standard deduction in 2026 moving forward, you can give up to $1,000 if you're an individual, $2,000 if you're married, filing joint, and deduct that and take standard deduction of $32,000. Last year it was like only $350. So that number has gone up drastically, or a lot, due to the OBBBA. So that makes sense. If you're giving more than the $1,000 or $2,000, then it will make sense to try to stack those and use a donor advised fund or do what Jack was talking about with a qualified charitable distribution out of the IRA. But if you're doing around that $2,000 using cash and taking standard deduction, you're going to get your same bang for the buck on that.
Yeah.
Sorry for interrupting.
Oh, it's beautiful.
All right.
Just wanted the other piece that we do a lot of here that Tyler and I are both firm believers in are what's called a donor advised fund. Earlier, when Tyler was talking, he was saying about, hey, sometimes it might make sense to game the system or play the game where one year you take standard deduction and the next year you might itemize. Well, the problem is, well, it's not a problem. It's a good thing that the standard deduction is so high, but that also means it's hard for people to itemize their deductions because if you're married filing jointly at a $32,000 standard deduction, for a lot of people, it's hard to get more itemized deductions than that. One of the strategies that we frequently deploy is what's called the donor advised fund, where you can essentially stack several years worth of charitable contributions into 1 year, and then you can take that itemized deduction in 1 year. I'll give an example. Let's say you're giving $10,000 a year to charities or churches or any 501c3 organization. Well, $10,000 is not more than $32,000. So more than less likely, you're going to take the standard deduction. So you're giving $10,000 away for charity, which is fantastic. You're doing your good part for the good part. You're getting your feelies out of it, except you're not getting a tax benefit for doing so. Where if you were to take 5 years worth of charitable contributions, because you were going to make them anyways, you were going to do $10,000 a year for the next 5 years, and you stack all of those years, so $50,000 into 1 year, and you use a donor advised fund, now you have a $50,000 itemized deduction, which is more than $32,000, the standard deduction, and allows you to take advantage of giving to churches and charities or 501c3s by stacking all of those in 1 year. That was like a 30-second, really quick, high level version of what a donor advised fund is. So if you have additional questions on it, please reach out to your advisor because it's a very viable strategy that we use in order to take advantage of charitable giving. Typically, when clients are doing it on a smaller scale, we can just say, hey, let's just stack 5 years in 1 year so we actually get the benefit of doing this. And then you get a higher deduction this year, and then the next year, more than less likely, you go back to taking standard, which is great.
Very cool. Yeah, very true. Um, yeah, do you want to go over the salt deduction changes?
Yeah. So so there is a part of the itemized deductions is what's called the SALT. That's your state and local taxes. Very funny that they called it SALT. Before that cap and the federal tax return was capped at $10,000. So if you paid more than $10,000 between your state income taxes, property taxes, and local taxes that you might be subject to, if you paid more than that, you could only take up to $10,000. Or with the passing of the One Big Beautiful Bill Act, that number got increased to $40,000. So that cap went up to 40. So you now, if you pay up to 40,000 between your state income taxes, property taxes, and any local taxes that might apply to you, you can now add that on to your itemized deductions. There are income limits to being able to use that SALT deduction. For joint filers, it starts phasing out between $500,000 and $600,000 worth of adjusted gross income. So it's a very high phase out limit. Majority of Americans are underneath that income limit. And so a majority of Americans are going to be able to utilize that full SALT deduction if they itemize.
99%. Sorry.
And for a single filer, that income phase out ranges from $250,000 to $300,000 worth of income. So if you are working with our tax team and you feel like, hey, I do pay a lot of state taxes. If you live in Minnesota, sure statement. If you pay a lot of property taxes or local taxes, it might be worth looking into to see, hey, should I be itemizing this year with how much I'm paying in taxes? So just wanted to throw that out there. That's another itemized deduction that can be added on. And that cap is now much higher at the $40,000 limit as compared to the $10,000 limit that we've seen since 2017.
Yeah, very good. I guess my part here is the next. A lot of people have heard that Social Security now is going to be tax free because of the OBBA. Well, that's partially true, and I would say partially true to the fact that if you make less than 100 as a joint family, making or a family a joint filing, married filing joint. My gosh, it is 4:35. Married filing jointly and less than $150,000 of modified adjusted gross income and below, you will get an additional $6,000 deduction, which if you do the math on it, the amount of Social Security that you get, that ultimately sort of makes that free. If you're over, or tax free if you're over age 65. So if you're 65 and above and your modified adjusted gross income, which is so how to figure out your modified adjusted gross income is 85% of the Social Security you receive plus any income. So that's your distributions from IRAs plus any extra wages you might be making doing a side hustle or that encore career. Add all that up, and if it's less than 150, you will get an additional $6,000 deduction, which in a sense makes the amount of Social Security that you're receiving, because you're over 65, tax free. So yes, Social Security is in a sense tax free if you are less than modified adjusted gross income 150 and 65 and above, with that new $6,000 additional deduction.
And correct me if I'm wrong.
Yes.
It's $12,000 for a married filing jointly, $6,000 for a single, is it not?
Correct. So
yes,
12,000 total. Yes.
Yeah, so that's a huge extra additional standard deduction on top of the normal standard deduction or the enhanced senior deduction.
So $48,000 deduction, technically, if you look at it, if you're making $149,999 of your modified adjusted gross income, you're not going to pay any income tax on, that's sweet. And that's where
any tax on Social Security, no income tax.
Yeah, on the first 48,000.
Yeah, on the first 48.
So the first 48,000 tax free, and then you go back. So, anyways, the point of going back to like at 4:05 when we started this, talking about the headwinds of quarter 1 and quarter 2. You're going to see a lot more, saying stimulus into the economy because there's going to be a little bit more cash in the economy that people are going to have in their pocketbooks. So I think that's pretty fun. I'm sort of excited to see what happens with it. Um, can't, yeah, I can't really think of much else on that aspect.
Yeah.
Did a pretty good job on that.
No.
I guess I'd like to highlight a couple of fun things that we have going on in the firm here. As you know, Lionel Lakes, we have that nice office up there, and then we have those 7 teammates that have been part of us since May 1st. And then we've added Grace. Well, actually, you could Grace.
Yeah. Grace Schulte joined our CSS team as one of our amazing CSSs. Her and I actually went to college together. She's a good personal friend. She's also phenomenal.
She's Gussie too.
Yeah, now we got 4 of us here, so we got a little Gustavus cohort going here. Grace Schulte is a phenomenal addition to our team. Extremely smart, extremely personable. She's a great addition to the CSS team. So she started back on January 5th. So she's almost at her 1 month mark. So if you see her name pop up in emails or you see her around, feel free to say hi, introduce yourself. I warned her before she accepted the job that all of our clients are unbelievably amazing, as are all the teammates on our team. So we're super excited to have her.
I'll go on the tax team here since they're too busy to be on this town hall today because it's tax season. And the tax team we've added, if you've seen, Greg Thompson comes from a couple of other CPA firms, if you will. He's got over 9 years experience of being a CPA, which is awesome. And then Stan Punkin, he's an enrolled agent, and he comes with 14 years of experience. So we've added some nice experience and depth to the bench. Josh Hill recently got his EA designations. That's an enrolled agent. I would say very similar to the CPA. It's just very much more tax intensive instead of it being CPA is very more broad, where there's accounting and audit inside that designation also. So very proud of the team that we have on staff to deliver that white glove experience that we're trying to deliver when it comes to the tax and wealth stuff together here. So again, reach out to the tax team and your wealth team. And yeah, I guess we can open it up for some questions here if you want to raise your hand. And we can always saw one earlier that wanted to raise their hand and ask a question, and we can push allow to talk and then unmute you, if you will. So we're ready to. Sorry, we can't do a chat function on this. We got in trouble last time. I think we said that last time. So
yeah, we'll stick around for a couple of minutes. Anybody is feel free to raise your hand, and we'll take you off of mute to ask a question. I'll preface this. If you have a question specific to your portfolio, your specific scenario, please reach out to your advisor and ask them that individually. If you have a broad-based question about something that's going on in the economy or something that has to do with taxes, by all means, this is the time to ask. We'll try our very best. This isn't high school. We're not going to make people sit here and think of questions, but this is the time that we want to offer people just ask any broad-based questions outside of, getting a hold of us via the phone or email. So we'll hang around here for another couple minutes, allow people to raise their hand and ask questions if they have them. If not, we'll end it a couple of minutes early and get everybody home for dinner time. Ooh. Yes.
has to unmute.
Don, you can go ahead and unmute yourself.
Yeah, hi, this is Don Wilbur. I'm a little curious about the the Treasuries auction coming up next week or 10 days from now. What's your prediction on how well that's going to sell out?
Sure, it's the Treasury auction. How well that's going to go in this upcoming. There was the question. Thank you for that question, Don. It's hard to project out what that's going to look like just because it's the last Treasury auction that happened 2 weeks ago went phenomenally well. It actually went better than they were initially anticipating for it to go. So our thoughts are that the treasury auctions are going to continue to go well. You're probably seeing, and I'm guessing why this question came up is there's a lot of stuff that you're seeing on the news where the dollar's being devalued because gold and silver are going up at such an exponentially high rate. And I'll go back to the fact that the US dollar is still used in over 70% of the world trade. It is the world's reserve currency. And so countries are still buying US Treasury investments as a store of value and as a safe investment for their balance sheets, or Federal Reserve, or just what's the word? Look, central banks of other countries are still buying United States Treasury investments. What do you have to add in on that?
Yeah, I'd add the fact that the treasury market, the more that they can sell and get off their own balance sheet, the better. And we've seen that work many times over with the quantitative tightening that they should have been doing a lot longer. Again, that's no personal opinion on that. Apologize, I'm not going to get too political, but I think when you see a lot of other countries in this, when you look at digital currencies of like crypto, and they came out with a stable coin, and that is really going to drive a lot more of the dollar value. I would think back up. My own thesis on it, due to the fact that the stable coin is exactly pegged to the US dollar. So it's another way for other countries that don't have a central bank. I think of African countries that their currencies are manipulated all the time. They're now going to be able to buy a stable coin very easily, readily available, pegged to the US dollar, which is only going to help use the US dollar, or the usage of the US dollar, that much more and stronger. I don't think the auction market is going to devalue our dollar as much as some pundits may think. But yeah, any other questions or feedback on that or thoughts?
Perfect. Appreciate the participation, Don. Thank you for asking that question. If anybody else wants to raise their hand, we are more than willing to answer any questions that exist out there.
Otherwise, yeah. Oh, I call on real resale.
Perfect. Well, again, if you have a question specific to your portfolio, if you don't feel like coming off of mute, you're not comfortable with that, please do not hesitate to reach out to your advisor. Reach out to Tyler and I, reach out to anybody on our team. We're all one team. We're here to help everybody, every client of Strategic Wealth Group. That's what we get up and what we're excited to do every single day. So if you have a question, if you want to talk more about the economy, your portfolio, some changes that you can make from a tax perspective early on in the year to put yourself in a better position for 365 days from now, please reach out to us. We're here to help. And with that, wish everybody an enjoyable rest of your night. And our next town hall is going to be on April 28th of this year. So about
Right
3
after
months
tax
from now.
season. So